Hello and welcome to Gold and Silver Assets. It's Sunday the 6th of September 2020. I don't know about where you are, but where I am, every man and his dog seems to be out with either a chainsaw, a lawnmower or a hedge trimmer or some other noisy garden implement. Anyway, I think I found a quiet spot right now, so let's see if that continues. And today we're going to talk about the third part of the bond series that we've been discussing, and this will be the last part. And this really will describe why I think it's important to look at bonds and how it relates to the gold price. As I said, this is the last one in this series, and next week we'll talk about something completely different. Let's start by looking at the history of nominal interest rates. I don't know how they did it, but this chart actually documents interest rates as far back as 3000 BC. For the last few centuries, interest rates have averaged at around 4%, and currently interest rates are as low as they have ever been. It does look like they did get pretty low in the 1930s. But one thing that is new is the emergence of negative interest rates. As we saw last week, this is something that's really only took hold in 2014 and has been growing significantly since then. Why does this occur? Well, there are two factors. One is the market itself bidding up the prices of bonds, and the other is central banks purchasing bonds. And both of these factors have the effect of pushing yields down. This chart shows how the yield curve of the Japanese government bonds changed over time. In 2012, so that's shown in blue here, you can see that the yield curve was positive throughout and it was steep. As quantitative easing was introduced, you can see that the curve got closer and closer to zero on the short end, and on the long end you can see that it became less steep, so we've got this flattening going on. In 2016, so that's this grey line here, the Bank of Japan introduced a negative interest rate policy, and so here you can see that the short rates dipped its toes into negative territory. And since then, and that's only over a period of 7 months, you can see here, you can see that as time went by, longer and longer rates became more and more negative. And so you've got flattening of this curve, which increased over time. And although the short end decreased a little bit, the long end decreased much more. Here's the equivalent chart for German bonds. In 2019, so that's this pink curve here, again, you can see that the yields were positive on the short end and on the long end, and the curve was reasonably steep here. Over time, as the short-term rates went into negative territory, again, you can see that the long end came down to a greater degree, and you can see successive flattening of the curve here. So as time goes by, longer and longer maturity dates go into negative territory. The first thing that I want to say is that negative interest rates is a very bizarre and unnatural phenomenon. You're effectively paying someone to borrow your cash. That doesn't sound right, does it? Yet it is occurring, and many countries around the world has had persistent negative rates for a few years now, as we can see. There are some theoretical benefits of negative interest rates. Firstly, it makes it easier to service large debts. Remember, though, that only banks and big corporations will benefit from borrowing at negative rates. For retail borrowers, the rates will still remain positive but low. If banks will be charged for holding cash, then that's a strong incentive for them to actually lend it out rather than keep hold of it. And so in theory, people will be encouraged to borrow more, and that's because interest rates are low. But I would question whether this would work if people are already up to their eyeballs in debt and the economy is going down the gurgler. Negative rates also, in theory, help by propping up the housing market because of the above 2 points. If negative interest rates are passed on to savers, that would be a disincentive for holding cash in the bank. And so, in theory, that would encourage spending. But paradoxically, that hasn't occurred yet in countries with negative interest rates. Negative interest rates also weakens the currency, and that's good for exports and so is therefore good for the economy. But on the flip side, it also makes imports expensive and so boosts inflation. Having said all that, there is also a dark side to negative interest rates. Banks hate it because it's bad for their profits. It's also bad for pension funds and insurance companies, as they do rely on interest rates to make their payments. As we've also said, it punishes savers, and in theory, it would encourage the hoarding of physical cash. But I don't think that will be the case in practice, since physical cash seems to be being phased out and everyone's being herded into digital payment systems. Okay, so a few countries have gone negative, but could it happen in the USA? The Federal Reserve have officially said that they're not considering it, but I always say never believe anything until it's been officially denied. The Bank of England have indicated that they are open to negative interest rates, and here in New Zealand, the central bank has officially told local banks that they must prepare their computer systems to handle negative rates by the end of the year. So for me, there's no doubt that it's coming here. If lots of other countries follow suit, then the effect of that will be that the US dollar will rise and could even spike. And so the Federal Reserve may decide to cut rates and go into negative territory to try and weaken the US dollar, to try and mitigate the fallout from having a strong dollar. Another potential reason would be to fight deflation. Remember that negative rates theoretically counteract deflation due to the benefits we discussed earlier. I don't know if negative rates will actually happen in the USA, but I do think it's a distinct possibility. But so what? Japan and Germany seem to be managing reasonably okay. Wouldn't it just play out in a similar way in the USA? The big difference here for me is that the US dollar is the world's reserve currency and so is used for international trade. And this is a really, really important point. Remember that all commodities are priced in US dollars. There's never been a time in history where the reserve currency has been a fiat currency, and indeed all major currencies are fiat. And so this is on a global scale, and this is all new to everyone. And so the consequences of a negative interest rate on a reserve currency are completely unknown. However, we can make some estimates of what could possibly happen. In the world of commodities, I think the concept of time preference will play an important part. Let's say someone comes to you asking to borrow a barrel of fuel from you, and they say that they can either return it the next day, or if you're willing to wait, they can return it in a month and they'll pay you $10 for your trouble. If you do take the 1 month deal, then you have what's called a low time preference. You're willing to put off owning stuff now in the hope of being better off later. In a negative interest rate environment, the offer would be quite different. they would be offering to return the fuel the next day, or if you wait a month, they would return it to you, but you would have to pay them $10 to get it back. In that case, you would naturally have a high time preference. You either won't even lend it out in the first place, or if you did lend it out, you would want it back pretty sharpish. Remember, we're talking about commodities here, which are necessities of life, and that's a very different situation when we're comparing it to, for example, the debt market. I therefore believe that if the world's reserve currency goes into negative rates, then commodities, including gold, will go into backwardation. It'll be better to own a physical commodity now rather than holding onto cash deposits and taking possession of the commodity later. Therefore, futures markets participants would be better off being long rather than short, and that's going to cause commodity prices to rise. I therefore think that if the world's reserve currency were to go into negative interest rates, that would be rocket fuel for gold and the commodities. Next up, the market update. Let's start by looking at gold priced in US dollars on the daily scale. And last week we were talking about this triangle that seemed to be forming, and I was pretty clear that this was the base of the triangle here shown in this line, but I wasn't sure about where the top line was going to be. And so initially we tried joining these lines, and then we've moved further up over here, and possibly that could be the top of the triangle there. It's hard to know. But the important thing to note here is that twice we've got wicks breaking down below that support trend line there. And the other thing is that we still haven't closed below this area here. And you can see here that we've got this dead straight line here. But there's a couple of possibilities here. One is that this could just turn around and shoot straight up there, but it's just looking a little bit on the weak side, and the fact that we've broken this support line twice suggests that this is weakening, so it's not going to take much for this to break and for price to drop. And there's not much support down here until we get into this zone over here. If we do drop, probably it'll drop and then we'll get a bit of a bounce up before coming down again. And let's move on to silver priced in US dollars on the daily scale. And again, we've got a similar situation. We're bouncing up and down in this sideways pattern. And again, we've moved back to the bottom and the support here at around $26. I'm still thinking it could well break, and again probably if it does break that 26, it will come down, bounce back up before making its next move down. And support is most likely going to be from this upward sloping trend line, and so we're looking at around the $22 level now. Obviously, as time goes by, that level will go higher and higher. There's an outside chance that we could go down to this line here, but I think it's a lower probability, but it's not impossible. And I very, very much doubt we'll go below 19 here. That's just too strong support. And as I said in the last video, we are very, very bullish. So for both gold and silver, remember that if it does drop, I think it will be short-lived, and the next bounce up will probably end up being quite epic once we get out of this this overhead area here. And moving on to gold miners, so this is the GDX, and again a few weeks ago we saw the break of this long-standing upwards trend line here. We've been moving sideways since then. We still haven't made a lower low yet though, although we have made lower highs. But to me, this is starting to look like it could be a descending triangle, in which case a break below this low opens up the target here of around 32. And let's have a look at the SILJ, so that's a silver junior miners. And again, we've got that upsloping trend line, and we've had a wick that's just broken below there. If we get a close below this line, then we've got a drop. The next support will be around the $11 to $12 area. That's it from me from this week. Don't forget to like and subscribe if you like this content. And if you're looking for bonus material, feel free to click the join button or the link in the description. All the best. See you next week. Bye.